Welcome to Quantified Strategies. Today we're talking about the options expiration week effect, often abbreviated Opex week, and the term we'll mostly use in this video. What is it, when is it, and can you make money during this week? Stick around and we'll answer all these questions for you in this video that contains 3 back-tested trading strategies. By the way, we're always working hard to create new and exciting content, so your likes and subscriptions really help us out. Let's start by showing the performance of S&P 500 during any Opex week. As a proxy for S&P 500, we use the ETF with the ticker code SPY. The trading rules are simple. We buy the Monday open of the Opex week and we sell at the close of the Opex day. The result is not a straight line, but it's sloping upwards. By being invested only during the options expiration week, you more than double your capital over the period. You made 153%. The CAGR, which is the compound annual growth rate during the options expiration week, is 3.1%, and the average gain is 0.3% per week, higher than any other random week. Based on this, we can argue that there is an Opex week effect. Keep in mind that you're invested only around 18% of the time, and the average number of bars in a trade is slightly less than 5. While it may not be a surefire way to get rich quick, it's still a promising option in our opinion. So there you have it, folks. Our backtest confirms that there's an options expiration week effect, and while it's not a standalone strategy, it can be used in conjunction with other parameters to make profitable trades. We'll now show you an example of a strategy that's based on the options expiration week, but has one added variable. But before we continue, let's briefly explain what the options expiration week is all about. Once a month, U.S. options expire on the third Friday of the month. Because options have a finite life, they stop trading at certain dates. This chart illustrates the Opex cycle. It's the countdown to each Opex day. Options expire because they're derivatives, and they stop trading. Some traders will lose money, some will gain, and the last trading days leading up to the third Friday of the month can sometimes be nerve-wracking for those traders involved. This creates opportunities because traders need to reconsider their positions. Because of this, trading activity in options can have a direct and measurable effect on stock prices, especially on the last trading day before expiration, something called pen risk. Now let's show you a specific Opex trading strategy that only takes trades on the Monday open of an options expiration week and exits at the close of the Opex day. However, we've added one extra simple rule. But the strategy is exclusive for our paying members and subscribers. The strategies for the ETFs with the ticker codes XLV and XLU, which are defensive healthcare and utility stocks. As you can see, the performance is good with an upward sloping equity curve. The annual returns are 4.5% despite being invested less than 10% of the time. The average gain per trade is 0.72%, which provides a huge margin of safety for slippage and commissions, which are very low for such liquid instruments. Let's show a third and last options expiration week strategy, the performance on the Opex day. The trading rules are simple. We short SPY at the open of any options expiration day, and we cover at the close. This is a day trade and shows that the Opex day is a pretty consistent losing day for the bulls. The average gain for this short trade is 0.16%, and it can be improved by adding a variable. However, that's for another video. We've shown you 3 back-tested trading strategies based on the options expiration week effect. That said, if you want to trade during the options expiration day or week, you might want to get a better understanding of what's happening and why. Thus, we've provided some frequently asked questions. What happens when a call option expires? An option resides within 2 states, in the money or out of the money. In the out-of-money scenario, the option reaches its expiration with no value, resulting in a loss of the initial investment for the owner. Conversely, the seller retains the premium in this situation. When the stock price surpasses the strike price prior to the call option's expiration, the option holder has the choice to either execute the option, acquiring the underlying shares, or to sell the calls within the market. What is pen risk? Pen risk comes from the uncertainty surrounding the potential exercise or assignment of an options contract. This occurs specifically when the expiration price of the underlying security aligns closely with the option's strike price. This phenomenon is termed penning a strike. For instance, if the XYZ stock concludes at $50 upon expiration, The strike price of $50 would be considered penned. What is quadruple witching day? Quad witching day is when all derivative contracts expire. All options and futures contracts expire on this particular day. This is in March, June, September, and December, 4 times per year. Is the Opex day a volatile day? Yes. For example, this chart shows the volatility of any random day, Opex day, and quadruple witching day. The statistics show that quadruple days are the most volatile, followed by Opex days and random days. Can options be exercised after hours? No. Exercising beyond the official trading hours is not possible. Nevertheless, there might be a possibility if your broker grants such an allowance. However, exercise caution as trading activity tends to be limited outside these designated hours. Do options expire at open or close? In the US, it's done at the close, not at the open, at the expiration day. However, OTC options might have different expiration times. That was all for today, and we hope you like it. And stay tuned for the next video coming up showing 3 profitable trading strategies. And by the way, don't forget to subscribe and like so we can keep delivering free videos.